Corporate governance is a system of rules, practice, and processes through which a company is directed and controlled. It refers to the way in which a company is governed and to what purpose. It also identifies who has power and accountability and who make decisions. So, it is in essence a toolkit that enables management and the board to deal more effectively with the challenges of running a company. Corporate governance ensures that businesses have appropriate decision-making processes and controls in place so that the interest of all stakeholders like shareholders, suppliers, customers, employees, and community are balanced. Governance at a corporate level include the processes through which a company's objectives are set and pursued in the context of social, regulatory, and market environment. It is concerned with practice and procedures for trying to make sure that the company is running in such a way that it achieves its objectives while ensuring that the stakeholders can have confidence that their trust in their company is well founded. There are 3 pillars of corporate governance. They are transparency, accountability, and security. The first pillar of corporate governance is transparency. Transparency means having nothing to hide. For a company, this means it allows its processes and transactions observable to outsiders. It also makes necessary disclosures and inform everyone affected about its decisions and compiles the legal requirements. Aside from stopping illegal money-making scheme, transparency also builds a good reputation to the company. When shareholders feel they can trust a company, they are willing to invest more, and this greatly helps to lowering the cost of capital. Accountability takes more than transparency to build integrity as a company. Accountability also means answerability or liability. Shareholders are deeply interested in who will take the blame when something goes wrong in one of the company's many processes. Even when everything goes smoothly as expected, knowing that someone will be held accountable for future mishaps increase the confidence of shareholders, which will in turn increase the desire to invest more. The third pillar of corporate governance is security. A company is expected to make their processes transparent and their people accountable while keeping the enterprise data secure from unauthorized access. There is simply no compromise for this. The companies experiencing security breaches involving exposure of their clients' personal information quickly lose their credibility. Thus, even with accountability and transparency, a company without adequate security measures will have hard time attracting their shareholders. After all, any scandal, even a breach caused by third-party hacker can have negative effect on company stock market performance. The increasing cybercrime puts security at a high priority for many companies. Taken together, transparency, accountability, and security defines a company's integrity. Achieving all 3 isn't an easy thing to do, but fortunately, companies now have a partner in board portal software, which also doubles as corporate governance software. A board portal doesn't just digitalize the whole board meeting process. It also makes the process more transparent by keeping a clear and complete documentation at all times.
Structure of corporate governance. Board of Directors. Board of Director is the apex body in the structure of corporate governance. Hence, the Board of Director is also called as those charged with governance. Board of Directors has the control over the management of the entity. All its decisions are made for fulfilling the long-term objective of the entity. The Board of Directors is responsible for monitoring the performance of the CEO of the entity. It must ensure that conflict of the interest does not arise due to any of its decisions. It is further responsible for taking care of the interests of various stakeholders. Board of Directors define the vision and mission statement of the entity which guides the team. Management. The management of the company is different from the Board of Directors. It is a subset of the Board of Directors led by the CEO of the company. CEO means the Chief Executive Officer, that is, the most important employee of the company who looks everything within the company. The CEO is responsible for preparing the strategies of the entity and the evaluation of the various associated risks. CEO is further held responsible for commenting on the performance of the entity and its financial reporting. The management is held responsible for the business operations of the company. Shareholders. These are the investors who had put their hard-earning money into the company with the confidence that the Board of Directors will manage the fund of the business of the company. Shareholders cannot invest their daily time in managing the affairs of the entity and hence they elect the director who will report them. To ensure the compliance and to enrich the corporate governance, shareholders appoint the auditors who will thoroughly audit the affairs of the entity and will provide the audit report. Take Amazon as example. It is one of the highest market capitalization in the world. The website of the giant company states that it started with 1997 letter to shareholders. The said letter states that the fundamental value of the company will be the shareholders' value of that company creates in a long run. Its corporate governance objectives are customer-centric approach, the objective of increasing the cash flow, maintaining a lean culture over the entity and spending the cash resources wisely, continuous hiring of the talented workforces, long-term consideration have more value than short-term profit. As depicted by the clear message from Amazon, the company is a well-settled image of its corporate governance. The satisfied employees over a globe are clear proof of the good corporate governance. Since their employees work hard in the middle of the pandemic COVID-19, Amazon provides huge performance bonuses over the globe for delivering values to the potential customers.